Hello everyone. Today I will be presenting a comprehensive overview of General Electric's transformation over the last 4 decades, focusing on leadership eras of Jack Welch, Jeffrey Immelt, John Flannery, and Larry Culp. We'll explore the strategic decisions, successes, and failures, and cultural shifts that shaped GE's trajectory. This presentation aims to provide insights on how leadership styles, market conditions, and corporate strategies intertwine in managing one of the world's most iconic conglomerates. Jack Welch's leadership of GE is often hailed as a golden era. When he took over in 1981, the U.S. was in a recession, but the economy rebounded strongly during his tenure, fueling GE's growth and stock market success. His strategy was clear: diversify aggressively, drive operational excellence, and maximize shareholder value. GE's stock hit record highs, reflecting investor confidence. However, when Jeff Immelt succeeded Welch in 2001, the company faced a dramatic different landscape. The September 11th attacks came just days after Immelt became CEO, triggering a recession and directly impacting several GE businesses, like insurance and aircraft leasing. The economic environment was far more volatile, and Immelt had to navigate these challenges while redefining GE's strategy for a new era. Immelt was determined to continue Welch's diversification strategy but ramped up the pace significantly. During his 16 years, GE executed over 380 acquisitions and divested roughly the same number, managing a staggering $575 billion in transactions. While this aggressive reshaping brought some success, such as expanding GE's media presence through NBC Universal and establishing a leading wind turbine business by acquiring Enron's assets, some decisions proved costly. The purchase of WMC, a subprime mortgage lender, exposed GE to enormous losses during the 2007 financial crisis. Similarly, Immelt's venture into Homeland Security failed to generate expected returns. Perhaps the most damaging was the $10.6 billion acquisition of Alstom's power business, which coincided with a rapid shift towards renewables, leading to a massive loss. Additionally, GE's capital's unchecked debt accumulation put GE at risk during the 2008 crisis, forcing emergency measures and damaging investor confidence. This era revealed the challenges of balancing bold acquisitions with risk management in a changing global economy. One of Immelt's core strategic moves was repositioning GE to capitalize on global infrastructure growth, particularly in developing countries where spending was booming. He reorganized GE to provide integrated infrastructure solutions, including power, water treatment, and transportation, aiming to be a one-stop shop for emerging market projects. Alongside this, the Eco-Imagination Initiative marked a major commitment to sustainable technologies. GE invested heavily in clean energy, energy-efficient products, and emission reductions, successfully growing revenues and profitability in this segment. The wind turbine business, originally from Enron's bankruptcy, grew into a multi-million-dollar operation. Despite these advances, GE faced hurdles entering emerging markets, where political, regulatory, and operational complexities made growth slower and more expensive than anticipated. Nonetheless, these themes define GE's vision for sustainable global leadership in industrial technology. Despite Immelt's ambitious strategies, GE's financial performance deteriorated, especially in its power division. Alstom's acquisition coincided with a global energy transition, reducing demand for fossil fuel power equipment. Simultaneously, the oil and gas segment was crushed by a steep drop in oil prices due to oversupply and geopolitical dynamics. Immelt continued expensive stock buybacks, encouraged by activist investors like Nelson Peltz, which drained cash at a time when the company's core businesses were underperforming. Analysts and insiders critiqued Immelt's optimistic messaging, calling it success theater because it failed to reflect the reality of operational problems. By the time Immelt retired, GE's stock was trading below its level in 2001, while the broader market had more than doubled, signaling investor disappointment and the need for fundamental turnaround. John Flannery inherited a company in crisis. He immediately acknowledged the gravity of GE's situation, describing recent results as completely unacceptable. To conserve cash, he cut the dividend in half, a painful move for investors, but necessary given the company's financial stress. Flannery focused on transforming GE's culture, emphasizing disciplined capital allocation, and aligning executive pay with free cash flow performance. He confronted difficult realities, including large unexpected losses in GE's long-term care insurance and ongoing mortgage-related liabilities that drew regulatory scrutiny. His strategic review led to the decision to divest multiple major businesses, including the profitable healthcare division, a controversial move, and refocusing the company around power, aviation, and renewables. Flannery also shifted GE's management style from a centralized command to empowering business units, aiming for greater agility and accountability. Despite these bold steps, the pace of recovery was slow, and the market remained skeptical. In late 2018, Larry Culp took the helm as GE's first CEO from outside the company's long-standing leadership ranks. He wasted no time implementing tough but necessary measures. Recognizing that preserving cash was paramount, Culp slashed the dividend to a normal 1 cent per share, shocking investors but stabilizing finances. He pushed through a series of major asset sales, including BioPharma and Baker Hughes, using the proceeds to aggressively pay down debt, reducing GE's overall debt burden by $75 billion within 3 years. Culp also focused heavily on improving operational efficiency, applying lean manufacturing techniques to streamline production and reduce costs. In 2021, he announced an ambitious plan to split GE into 3 separate publicly traded companies: healthcare, energy, and aerospace, to unlock value and allow each to focus on its core strengths with greater strategic clarity. GE's journey over the past 4 decades offers several important strategic lessons. First, diversification and acquisitions can fuel growth, but only when supported by careful risk management and market awareness. Emilt's era showed how misaligned timing or lack of discipline can erode value. Second, capital allocation must be rigorous and transparent. Maintaining investor trust, though honest communication and challenges, is crucial. Third, corporate culture must evolve to meet new realities. Ignoring bad news or success theater ultimately undermines credibility. And finally, strategic focus and operational simplification, as pursued by Culp, are powerful tools to rebuild a complex conglomerate. Leadership accountability and willingness to make decisions are essential for long-term success. In conclusion, GE's story over the past 40 years reveals how leadership and strategy must adapt to shifting economies, technological change, and competitive landscapes. Jack Welch's tenure capitalized on a strong economy and consistent growth, while Jeff Immelt faced extraordinary external shocks and changing markets that demanded new strategies. Flannery and Culp have worked to right the ship through reconstruction and renewed focus on industrial strengths. GE's experience highlights the importance of clear strategy, honest leadership, financial discipline, and cultural adaptability in navigating complex global businesses. Thank you.